Warren Buffett does not keep $1 billion in his checkings account, and Mark Zuckerberg doesn't keep $100 million under his mattress, yet these guys are worth billions of dollars. So what do they do with their money? Well, they are worth billions of dollars on paper, which is how many people, especially many wealthy people, build a lot of their wealth, because their wealth is built through a concept called equity. There's a difference between being worth $1 million and having $1 million. There's a difference between being worth $1 million and earning $1 million. And this is the concept that many wealthy people understand. They understand the difference between earning the money and having the money. And this is a concept that most of us are never taught, because there's this invisible type of money called equity that most people only see through their home. This is the concept of equity that most people are familiar with. You buy a home for $300,000, and if you get lucky, maybe you can sell your home for $400,000. There's this invisible equity that just because you bought a good home, you owned that home for a while, and because it was in a good area, you can sell this home for a profit without you having to do anything. You just got to sit in the home, own the home, live in the home, and this money now, this invisible money, gets to come to you when you sell this investment, this home, because now you have this money, this equity that you can now cash out, and this is something that you have in your pocket. But real wealth isn't built through just owning a home. It's through owning equity in different types of investments. Mark Zuckerberg has equity in Facebook. Meta is what it's called nowadays, but he has equity in the Meta company. Warren Buffett has equity in a ton of different companies like Coca-Cola, because his business is buying or gaining equity in these companies. And so what they're trying to do is they're using their money not to go out and just buy big homes, but to go out and buy or grow their business. Warren Buffett is going out and he's buying companies. He's trying to build his equity in companies. Mark Zuckerberg is building his equity in his own company by trying to increase the valuation of that, kind of like how people will remodel their kitchen or finish the basement. Mark Zuckerberg is buying other businesses and trying to come up with new ideas to grow the valuation of his own company, because when the value of his company goes up, it's like the value of your home going up. But you have very little control over how you can increase the equity or value of your home. Sure, maybe you can upgrade the kitchen and the basement, but you can't really move the home and you can't really do much. I mean, you can't turn your home into a 20-story building in 99.999% of instances, so there's very limited upside with your home. Versus with the business, there's no upside. That's what Mark Zuckerberg is doing. He's trying to do many different things. He's trying to buy more businesses. He's trying to create more revenue streams. He's trying to get more dollars out of each of his advertisers. So he's trying to bring up the value by increasing the revenue, by increasing the profits. And so there's different ways of looking at the equity. And this is what wealthy people understand, because a lot of millionaires don't have $1 million in the bank account. They're worth $1 million. They can spend a lot of money, but they don't have $1 million just sitting there. And they wouldn't want to either. Because if you have millions of dollars sitting in your bank account, earning even 1% interest a year, while inflation is many times more than 1% a year, that means this $1 million or $10 million or $100 million or $1 billion that you have in the bank is losing value to inflation. Because now, if your inflation is eating away at the value of your savings, you're slowly becoming broker. That's why wealthy people don't want to keep all their cash in the bank, because their cash in the bank is going to be losing value. That $1 million is going to buy less stuff next year than it can this year. So this is where now you want to put yourself into the mindset of understanding, what do wealthy people do? What do millionaires do? That way you can do what millionaires do and then become a millionaire. That way you can actually be that millionaire as well. Now, there's two things that I want to talk about when it comes to this. Because the first part regarding net worth is, I am not a huge fan of like this whole idea of bragging about net worth, because it's a fleeting indicator. Your net worth can be cut in half in a second, because if your stock tanks, if the valuation of your company tanks, then so does your net worth. And so when people live off of their net worth, well, you're living a very risky lifestyle, because now you assume that you're worth $1 million, $100,000, $10,000, $10 million, it doesn't matter. When you live based off of what your net worth is today, because now you're going into debt to finance your lifestyle, you are assuming that your net worth will grow and it will continue to grow. That way you can continue to borrow more money. It is a high risk lifestyle, and that's not what I recommend you do, because I want you to be actually wealthy. Where now you're not financing all the nice stuff, you can actually afford the nice stuff, but it's understanding this concept of equity when it comes to wealth, because this is what millionaires understand. It's much more difficult to go out and earn $1 million than it is to be worth $1 million. It's significantly more difficult to earn $1 million than it is to sell something worth $1 million. Yet they both can put $1 million in your pocket. So if you want to become a millionaire, it's easier for you to understand how to do this than it is to do this. Let's talk about this. How can you earn $1 million in a year? Well, most jobs are not going to pay $1 million a year. It's a fact. At your company, there's a big chance that you're not going to be able to earn $1 million a year. Most corporations have a cap on people's salaries, and most people are not going to be able to earn $1 million a year. There are some exceptions to this. You have some salespeople that will be able to earn more than $1 million. You have executives that will be able to earn more than $1 million. But for the vast majority of jobs, it is going to be impossible to earn $1 million a year from your job. So then the alternative is you're going to have to be an entrepreneur, you're going to have to start a business, and now you're going to have to create your own income. Now, yes, it is possible, but it is much more difficult. Being an entrepreneur is not for everybody. You're going to have to make a lot of sacrifices, and you're going to have to put in years of work with a lot of sacrifices before you can see those returns. So yes, it is possible to make $1 million a year, but it is very difficult in that you're probably going to have to start a business in order to do that. You're going to have to be a business owner, because now you have the ability to create your own income, which allows you to earn more money. And a big chunk of this $1 million that you're probably going to earn as a business owner, it's probably going to come from your equity anyways, so it's kind of cheating, because now you own the business, which is why you're getting all that upside. So it's a little bit of cheating there, but it's very difficult to earn $1 million a year just from your labor, just from your salary. This brings me to the second side. How can you now have something worth $1 million? Well, the first option is probably the most obvious, is you buy a home that you live in, and then the home that you live in goes up in value by $1 million. This is probably the most well-known and most accepted way for someone to make $1 million, because now you are owning a home into wealth. This is what has been known as a traditional American dream, where now you own a home, you work to pay it off, and hopefully home prices will always go up. But we know that home prices don't always go up, and buying a home as an investment is one of the worst ways to actually build wealth when you see kind of all the other things that I'm going to be talking about. The real value comes when you own something worth $1 million. And the nice thing is you don't have to have $1 million to own something worth $1 million if you do it the right way. Because now if you make slow, small, compounding steps where you're slowly putting money away towards your investments, you can see your investment portfolio grow to over $1 million, because now what you're doing is first you're putting your money to work. Because now the money you put to work, whether it's $10, $100, $1,000, $10,000, $100,000, or $1 million, it does not matter. When you put your money to work, this money is working to earn you more money. And then what you want to do is keep putting in more money into this snowball. So you start with $10. Now your $10 is working to earn you more dollars, and then you put in another $10. Now your first $10 is working to get you $1, and now you have this $10 working to get you money, that $1 that your $10 brought in working to earn you more money, and then you put in another $10, which is working to earn you more money. And you keep doing this again and again and again, because now you're putting more money into it, which is working to attract you more money, and the money that your money earns is also working to attract you more money. So as you put the money and the time into it, it starts to grow faster and faster and faster over time. This is what investing is all about. This is where the real wealth is built. I've talked about this before, but you can become a millionaire with $4 a day if you start when you're 21 years old. Because if you start putting aside $4 a day at the age of 21, and you invest this $4 a day, which is just over $100 a month, every single month, every single day over the next 46 years, from the age of 21 until the age of 66, and you can get an average stock market return, which historically has been about 10% a year. If you do that, you will retire a millionaire based off of your $4 a day investment. Now, the numbers show us this. And so this is where it's a matter of just understanding, how do you do it, what do you do, and what happens if you're not 21 years old? Because first off, we start to get this like FOMO where I don't want to wait until I'm 66. I want to have more money today. I want to have more investments today, and that's fine. But that means you're going to have to be more aggressive. You're going to have to put aside more than $4 a day. But I'm just showing you that it's possible, even if you only have $4 a day to put aside. Now, of course, if you want to go into the real nitty-gritty of how do you actually invest your money, I have a free guide on passive income that you can read where my team broke down how do you start investing your money, how can you start generating passive income, and how can you do this even if you don't have a ton of money. This guide is completely free, and you can read this guide by clicking the link down in the description below. But this is where you want to understand risk, and you want to understand the different ways to control this money. Because now let me compare two different asset classes to give you a very broad example. If you compare the real estate market to the stock market, they work two very different ways. Because in the stock market, your goal is to build equity. You want to buy companies, you want to buy investments that will grow in value because now your investment portfolio will grow, and then you can sell this investment portfolio for a big profit, hopefully millions of dollars. In the real estate market, you can do the same thing or something a little bit different, because in the real estate market, it's a matter of control. You have people like Donald Trump who owns billions of dollars worth of real estate. Now, for someone like Donald Trump, you might not care about equity. You might not care about having a whole bunch of skin in the game. Instead, what you're caring about is control over the asset, because when you have control over the asset, the building, the investment property, so let's talk about an apartment complex. The apartment complex has people living in the apartment complex, tenants who are now paying rent. This rent will then cover all of your building expenses, your taxes, your insurance, your maintenance, your management fees, and then it'll pay for the mortgage. It'll pay for paying back the bank and hopefully put some money in your pocket. That's the value of controlling the asset, because now the profit in cash flow every month goes into your pocket as the owner of the real estate building. Now, some real estate investors don't care about equity, because anytime the real estate values go up, they don't want this invisible money just sitting there because it's not doing anything. Because if you bought a building for $1 million and now it's worth $2 million, it doesn't really do you any good because that building is just sitting there. It's invisible money. You don't get that $2 million until you sell, unless you pull cash out of the building. What does that mean? Doing something like a refinance, where you go back to the bank and you say, hey, I bought the building at $1 million. You gave me a $700,000 loan on this $1 million building, but now this building is worth $2 million. Can you do something else? And now the bank might say, sure, here's a $1.6 million check, maybe even a $1.8 million check, depending on your relationship with the bank. And so now you have essentially pulled all the cash out of the building. You have very little equity left in the building, but now the cash is in your pocket. This is where some real estate investors don't care about the equity, because now, yeah, you have more debt, you have a bigger mortgage payment, but hopefully, if you do it right, your cash flow from the building will cover this higher mortgage payment that you have to pay. It'll cover all your expenses and still put some money in your pocket. So it's not so much about the equity, it's about the cash flow, which comes from the control. Now, of course, I do want to say this right now, which is there's more risk when you have less equity. And this is where you have to manage how much risk are you willing to take, because if you have full equity in the building, you don't have any debt, your risk is extremely low. Because now if tenants leave and you have issues, well, you don't have to worry about a bank knocking on your door if you can't make your mortgage payment. So you have to be able to balance the risk, and you have to be able to balance the debt. In the stock market, it works very differently. Now you're making an investment, hoping that your investment will grow in value. That way now you have a big investment portfolio that you can one day sell or pass down, because now it's worth a whole lot more money. You invest $10,000 today, and maybe in 10 years, this $10,000, if you make good investments, could be worth $100,000. Why? Because the companies that you're investing in are working to grow in value. So now, if you invest in a company, let's just talk about Apple, for example. Apple computers, Apple iPhones, Apple AirPods, Apple, all that stuff. The company is working to produce more products, to make more revenue, to make more profit, because they want to provide more value to consumers. Now, either you can go out and start something like this yourself, or you can just invest in the company, because now you're owning a piece, aka equity in the company, so that when they grow, when they produce more value, you get a piece of the upside. But it comes with risk, because Apple could also produce something very bad, and it could force the company into bankruptcy, in which case you lose your equity. So equity comes with risk, because now the equity could be lost. You're losing your principal, you're losing the value of your investment. So you have the risk of downside, but you also have the potential upside, which is where now you have to be able to balance risk. And this becomes a lot more apparent when we talk about something like a startup. because now there are platforms like Republic. They're not paying me to say this, but Republic is one of the startup platforms out there where now you can invest in startup companies, kind of like Shark Tank, with something like $100. So now what can you do? You have a bunch of entrepreneurs that are trying to raise money at an early stage. Now the nice thing for you is that you can come in and buy equity at an early stage in the company. Because now these companies, some of them might be pre-revenue, some of them might be trying to earn their first $1 million, some of them might be trying to earn their first $10 million. And so you can come in and buy into a company at an early stage, which means if this company were ever to go public, meaning go on the stock market, or if this company were to get acquired by a bigger company, you might be able to see a big payout. Because maybe this company is worth $1 million, $10 million, or $50 million today, but it could be worth 10x or 100x or even 1,000x what it is today sometime in the future. But the risk now is when you're investing in a startup that's so small, is there's a much bigger chance that it'll also be worth 0. So now you look at the odds. Hey, there's maybe a 1 in 20 chance that it will 10x, but a 19 in 20 chance that it will go to 0. And so this is kind of where now you have to be able to balance your risk and understand, okay, here are the potential returns with investing in this. You have the potential return of making a lot of money, but you also have the potential failure of losing everything. This is one of the most powerful things to understand because there are very few other places in life where you can get these types of returns. Because I'm a football guy and you can throw Hail Marys all day long. And now the nice thing is if you catch one of those Hail Marys, you might get 6 points. You score a touchdown, you get a Hail Mary. But the downfall is if you do 2 Hail Marys in a row, you don't get any additional points. You just get 6 points per touchdown that you get. However, in business, there's no cap on the upside. There's no 10x limit or 100x limit or even 1,000x limit. There's no limit to what type of returns that you can get. But this requires you to have some skin in the game, aka have some equity. Now, how do you get this equity? You can either buy it or you can build it. I talked about how you can build it a little bit earlier. We kind of foreshadowed this, that if you are of that entrepreneurial mind, you are that business type person, you are that hustler, you are that creative entrepreneur, then you can build this equity. And you can start with as little as $100. Like I started the minority mindset companies with less than a few $100. And with that, I started making YouTube videos, and then I started my other companies, things like Market Briefs, things like Market Insiders, things like my new tax firm that I'm working on. But it all started with less than a few $100, and I was able to grow the few $100 investment into a lot bigger equity into all of my companies today. But again, building a business is not for everybody. However, everybody needs to be a business owner. And so if you can't build the business, then the next best thing is to buy it. Now, how do you buy it? You can invest in startups. You can invest in real estate, not just the real estate that you're living in, but actual rental properties that you can build equity in and build this control over. You can invest in companies on the stock market. There are so many different ways for you to invest your money and get this equity, but this is where you just have to understand where on the spectrum do you want to be. Do you want to be one of the people that's building the equity or one of the people that's buying the equity? Both of them can make you extremely wealthy. Warren Buffett is one of the people that just buys the equity. He doesn't build companies, he buys companies, and he's one of the wealthiest people in the world. Mark Zuckerberg is in the game of building equity. He's trying to build Facebook, he's trying to grow the value of Facebook because that's something that he likes to do. Now, you have to decide where on the spectrum you want to be. You can be extremely wealthy in either one, but at the end of the day, it all comes down to equity. It doesn't matter if it's stocks or real estate or both or whatever it is that you want to do, but you have to have some sort of equity that can grow in value because no real wealth can be built through your salary alone. Your salary can help, but it can't be done with your salary alone because when you just rely on your salary, you're just one step away from being broke because now you are 100% reliant on you. If you break your leg, you get sick or something happens and you can't go to work, your salary is gone. You have no other income coming in. But when you have equity that is not just reliant on you, this is why real wealth is built through equity, and you have to be able to capture this equity, and you can either build it or you can buy it, and this is where you have to decide what's better for you. As I've become more financially educated, as I've become more successful, I've learned that that's one big lie. Sure, you can build some sort of generational wealth through home ownership, but that's not the only way. You can build generational wealth through the stock market. You can build generational wealth through real estate. You can build generational wealth through physical gold. You can also build generational wealth through businesses